Hello everyone and welcome back to the Saigal Seatrade podcast. I am research analyst Shruti, your host for today. And today we are diving into a seismic shift in global energy markets that's sending ripples through shipping lanes worldwide. After 70 days without imports, China has completely halted all liquefied natural gas, or one can say LNG purchases from the United States, what many are calling an energy divorce, with profound implications for global trade, geopolitics, and the shipping industry. Joining me today is an expert in shipping and commodity markets, Mr. Sandesh Ghandat. Sandesh, thank you so much for joining us today.
Thanks for having me, Shruti. I am excited to dig into this topic because, what we are witnessing isn't just a temporary trade disruption. It's potentially fundamental restructuring of global energy flows that essentially will impact shipping routes, and then it will impact on vessel deployment and then the freight rates for years to come.
That's correct, Sandesh. And I think before we get into the current situation, I think our listeners should benefit from understanding the history here. So can you walk us through how the China-US LNG relationship developed over the years and what made it significant to global markets?
Absolutely, Shruti. The China-US LNG relationship, it has had quite the roller coaster journey over the past decade, and understanding this history is kind of crucial to grasping the significance of the current breakup. So if I have to say, let's rewind to 2016, when the US began exporting LNG from the lower 48 states for the first time. China quickly emerged as an enthusiastic customer. And in that year itself, US LNG shipment to China totaled roughly around, 0.35 million tons. Now it looks like small in absolute terms, but a significant foothold in a market that was just opening up. We moved 1 year ahead by 2017. This figure has surged dramatically over 2 million tons per annum. And with China, its share accounting nearly 15% of all US LNG exports. From a shipping perspective, this created an entirely new trade route. We saw specialized LNG carriers, each worth around, 200 million at that time, beginning regular journeys from export terminals in places like Sabine Pass in Louisiana and, of course, your Corpus Christi in Texas, to Chinese receiver terminals in places like Shanghai and then Tianjin. Each of these vessels, they carry around 170,000 cubic meters of LNG. And you know what? It is enough to power a city the size of Boston for about a week. So this new trade lane was generating significant ton-mile demand. And it was a kind of a lifeblood of shipping economics. But then came the first major disruption during the initial Trump administration. So in 2018, as the trade tensions, they got escalated, and then China imposed a retaliatory tariff on US LNG. First 10%, then hiking them to 25%. The effect was immediate and dramatic. And US LNG export to China plummeted to near zero by 2019, and it impacted the vessels. So all those vessels, they had to find alternative deployment, and the ship owners with the vessel chartered to this trade suddenly had to scramble. The relationship only recovered after the phase 1 trade agreement in early 2020. So that was around 2 years we saw a drop in the shipment. And you know what? That year, US LNG volumes to China, they rebound over 4 million tons. And then the next year, by 2021, they hit record 9.3 million tons per annum. So in dollar terms, these deals were worth around $3.4 billion. So for us in the shipping industry, this means kind of a stable, predictable long-haul voyages, the kind that ship owners dreamt about. During this peak period, dozens of long-term contracts were also signed, and those were between US suppliers and Chinese buyers. And these weren't just spot arrangements, those are the long-term contracts. 20-year commitment that, project developers were counting on to underwrite massive infrastructure investment. So from a maritime perspective, these particular contracts, they just represented a sustained employment, specifically for the LNG fleet, and that has been expanded rapidly to meet the projected demand. Now, by 2022, we saw another shift. US LNG flows to China, they dropped sharply, not because of politics this time, but because of Europe kind of reeling from Russia's war in Ukraine and was bidding aggressively for any available cargoes. And then we have European buyers paying premium prices that Chinese buyers weren't willing to match. So US LNG carriers that had been kind of regulars in Chinese ports suddenly diverting to Rotterdam, Barcelona and the other European terminals. So the European LNG or European gas was kind of a hot topic just after the US-Russia war, and that's what changes significant LNG dynamics. Now during this time, Chinese import from US, they hovered around 2 million tons per annum in 2022 and rose just modestly in 2023 and never recovering to their 2020's peak. So throughout this period, Shruti, China was strategically diversifying its supply sources and they kind of secured more volume from Qatar, Australia and even Russia. And while US exporters were enjoying this unexpected European premium market, Chinese buyers busy with the other suppliers because they want to source and diversify their procurement patterns. So what's particularly interesting from a shipping perspective is how the industry is adapted to this shifting trade pattern. So when US China flows they diminished, we saw more triangular voyages, going from US to Europe, and then the vessel is ballasting to Qatar. Again from Qatar it pick a cargo bound for Asia, specifically for India. The flexibility of the global LNG fleet has been remarkable, but each rerouting comes with a cost and inefficiencies. So that was the history. Now let's go into the current market scenario, Shruti. We have Beijing. It has abrupt suspension of US LNG imports in 2025. The relationship that has been collapsed entirely. We have seen contracts being frozen, cargoes already loaded being diverted, and then terminals with the exposure to Chinese buyers, they kind of are facing the real prospect of default or renegotiation. In just few weeks, a decade of growth has been reversed and the shipping patterns established over that particular period have been thrown into disarray. So the implications for shipping are profound, and the LNG carrier market had been counting on sustained growth in this particular trade lane. We have seen there are shipyards in South Korea and China. They have their order books filled with new LNG carriers, many commissioned with the US China flows in the mind. Now those vessels will be entering in a market with very different dynamics than anticipated when they were ordered. And you know what? This isn't just about the loss of direct voyage between Texas and Shanghai. It's all about the kind of fundamental reconfiguration of how global gas flows that will require the entire shipping industry to adapt. And that adaptation comes with the cost. And mark my words, that cost is nothing but financial, operation and strategic requirement that will ripple through the market for years to come.
Thank you, Sandesh, for putting forth that fascinating context. Now, coming to the current situation, it's been 70 days since China imported any LNG from the United States. So, please break down for us as to what triggered this complete halt and what immediate effects it's having on shipping markets and global energy flows.
Well, Shruti, first of all, you were right to call this a crisis because after 70 days without a single US LNG cargo arriving at Chinese terminal, this is not a temporary disruption. This is a structural break in a major energy trade flow that's sending shockwaves throughout the shipping and energy markets. So this current crisis, Shruti, it began in February 2025 when the Trump administration imposed 10% tariff on all Chinese imports. Then China, it responded with its own retaliatory measures, including the 15% tariff on US LNG. It started on February 10th, and what might have seemed like just another round in the ongoing trade spat that quickly escalated with the tit for tat increases. We moved ahead with the same tit for tat strategy, and then we came into the month of April, and by mid-April, US tariffs had reached a staggering 145%. And then Chinese tariff, they hit 125%. Now at these levels, the economics of the trade, it completely collapsed. And it's not just for LNG, but it's for other markets too. Specifically, those are in the energy space. So the immediate impact on the global shipping patterns, it has been dramatic. From a maritime perspective, we have observed several key developments. Let me analyze it one by one. So first, we are seeing a massive rerouting of vessels, that would have carried US LNG to China. These ships, instead of heading to Europe, it putting a pressure on terminal capacity there. For instance, let's take an example of Rotterdam, Shruti. So in Rotterdam, we have a gate terminal, and in Spain, we have a Barcelona facility. So both these terminals, they're reporting significantly increased utilization rates. So this shift affects not just the vessels themselves, but even the port operation. And then we have a terminal scheduling, and then downstream transportation network. So on a bird's view, it looks like a good thing that they are getting higher number of cargoes, but it eventually puts burden on the operation, and it eventually pushes the terminal owners to utilize that gas in a downstream process fast, and that is not an easy prospect considering the fact that Europe's demand for LNG is significant over the years, but now it's declining because the implied effect of weather patterns are not there. Analyzing the second point is the freight rates. Now for the LNG carriers on trans-Pacific routes initially plummeted as demand vanished overnight. We saw a spot rate for standard 174,000 cubic meter carriers, let's say it's a MEGI vessel, MEGI vessel, they dropped nearly 30% in the weeks following the Chinese announcement. However, we have seen the rates have since stabilized as vessels have been redeployed to alternative routes, particularly US to Europe. But the implied effect on the freight rates will continue to be there because that volatility will be there as long as these cargoes from US to China, they were not materialized. Now analyzing the third point, the average voyage length has changed significantly. You know what? The standard journey from Sabine Pass to Shanghai, it is approximately 45 days round trip. By contrast, Sabine Pass to Rotterdam is about 30 days round trip. What we are analyzing here? We are analyzing there is a reduction in the voyage duration, means each vessel can complete more journeys per year, effectively increasing availability in the shipping capacity in the market. This is what? This is the surplus capacity. So this surplus capacity has placed downward pressure on the rates. Now the fourth point is this. We are witnessing significant disruption to the traditionally triangular trading patterns that has been developed. Previously, many vessels would load US and then they discharge in China. Then again they ballast to Australia or Qatar to pick up a return cargo. Now this triangular momentum is completely vanished because now these vessels are scrambling to find efficient new patterns, often resulting kind of a longer ballast legs where ship sails empty, which kind of economically inefficient and environmentally also problematic, because we are now thinking LNG as more sustainable and kind of a transition fuel. From an energy market perspective, the impact have been equally profound because US LNG exporters, now they suddenly lost access to what had been their second largest market. In 2024, China imported around 6 BCM of US LNG. While this represents only about 5% of total US exports, the loss of this market has created significant oversupply in the short term. Now take a look at the gas prices. So gas prices at the domestic US Henry Hub, they initially dropped by about 8% in the weeks following China's announcement. And the cargoes intended for the Chinese markets, they were also redirected. Now meanwhile, European TTF prices, they saw temporary volatility as the market it kind of absorbed and redirected the volume. The Chinese buyers, they have pivoted dramatically to alternative suppliers. Russian LNG imports to China have surged by really 25% since February, and then we have seen increased purchase from Qatar and Australia as well. So this has created a sort of musical chairs in the global LNG markets, with everyone rushing to secure new supply relationships. So Shruti, what's particularly concerning for the shipping planners is, the medium term uncertainty, because US has approximately 25 BCM of LNG contracted to the Chinese buyers. They scheduled to come online over the next 4 years. So if these contracts cannot be fulfilled due to any ongoing tariffs, those volume will need to find alternative markets, and we are talking about 25 BCM. That is actually a very large number. That is why it is creating significant uncertainty for the shipping requirement. For vessel owners with the long-term charters linked to these particular contracts, there is a considerable anxiety, because just look at this example, Shruti. A charter that was signed with the expectation of regular US China voyages, now it faces potential renegotiation because the flows are stopped, or it could simply face a cancellation, because each LNG carrier, it represents an investment of around $200 million. So these are high stakes concerns. We are also seeing impacts on the shipbuilding orders. We have several Chinese firms commission new LNG carriers specifically for this US China trade. Now these vessels still under construction at shipyards in South Korea, they kind of are facing an uncertain deployment future. And perhaps most important thing is what we are seeing at the Panama Canal. It is a kind of a critical transit point for US LNG shipments to Asia. Now, canal authorities report that the number of LNG carrier transits, they dropped by roughly 30% in the March 2025 if we compared with the last month of the last year, that is December 2024. So each transit, it generates approximately $500,000 in fees for the Panama Canal Authority, and this represents a significant revenue loss for the Canal Authority as well. So the bottom line is that a major artery of global energy trade, it has been severed like any system suddenly deprived of key connection. The global LNG shipping network is experiencing significant strain as it attempts to reconfigure itself around this new reality. And the longer this divorce continues, the more permanent these new patterns will become.
That was quite an explanation, Sandesh. And from what I understand, the strategic implications of this LNG divorce are profound and multi-layered. And we should also look for US LNG infra, don't you think? So the US LNG sector has over 20 proposed export terminals in various stages of development along the Gulf Coast. Now, these represent approximately 100 million tons per annum of additional export capacity. So now that's a massive expansion that would require hundreds of additional LNG carrier voyages annually. So projects like Venture Global, CP2 or Sempra's Port Arthur and next decade's Rio Grande have already secured partial financing or begun early construction. But however, these projects were largely predicated on the assumption of growing Asian demand, particularly from China. And without Chinese offtake, nearly one-third of the volume committed to future US projects has effectively evaporated. Now for shipping, this means potentially hundreds of voyages that will never materialize. So the economics of these terminals are now in serious question, you see. Even facilities that reach completion may operate at lower utilization rates than projected. And lower utilization means fewer cargo loadings, which directly translates to reduced shipping demand, as we all know. So for ship owners who have ordered vessels in anticipation of this growth, there's now a real risk of overcapacity in the specialized LNG carrier fleet. So each large LNG export terminal now requires between 5 and 8 dedicated LNG carriers to service at full capacity. With multiple terminals now facing uncertain futures, the impact on vessel demand could be significant. And we are already seeing early signs of order cancellations and delays for new build vessels. And you mentioned about disruptions earlier. This is clearly more than just a temporary disruption. Let's zoom out and look at the bigger picture. What are the long-term strategic implications of this LNG divorce between the world's largest exporter and what was once a major customer? How might this reshape global shipping patterns and investment decisions in the years ahead? What do you think, Sandesh?
Well, Shruti, first of all, thanks for that brief overview. So, what I think is there is a major geopolitical dimension that will reshape the trade flows. The US China split is kind of occurring simultaneously with the growing tensions between European Union and Russian LNG suppliers. So, the EU imported about 19 BCM of Russian LNG in 2024, but there are increasing calls to ban these imports by 2027. So, the US sanctions they have already caused operations at Russia's Petrovaya and Vostok LNG facilities to cease in February 2025. And this creates a complex three-dimensional chess game of redirected cargoes. And what is that? So Russian LNG that previously went to Europe is kind of increasingly heading to China. The second one is US LNG that would have gone to China now is being redirected to the Europe. So from a shipping perspective, this actually increases ton mile demand in some respects, as these crisscrossing journeys are less efficient than direct routes would be. So the redrawing of this energy relationship, that has profound implication for strategic shipping choke points as well. We are seeing reduced LNG carrier traffic through the Panama Canal as fewer US cargoes head to Asia. Meanwhile, the traffic through the Suez Canal for Russian and Qatari LNG is heading to Asia is increasing. So this shifts the maritime security focus and creates new patterns of risk exposure for ship owners and insurers as well. There is an emerging regulatory divergence that could create a two-tier LNG market with the significant implications for shipping. At one side, we have a European Union. They have their own methane regulation. They kind of adopted that in August 2024. And they plans to introduce maximum methane intensity values for imported LNG by 2030. So it's 5-6 years later. Meanwhile, in the US, environmental regulations, they are being rolled back, with the Senate repealing the methane fee on excessive fugitive emissions in the February 2025. On one side, we have seen regulations intensifying, and then on the other side, we are seeing some regulations eased. Now the regulatory divergence, it could lead to the creation of clean and dirty LNG streams with the different destinations markets requiring different specifications. For shipping, this potentially means that dedicated vessel pools, those serving specific markets, rather than the flexible global deployment that has characterized the LNG fleet in the recent years. Now we are seeing significant changes in the contracting structures as well. And you know what? That will affect shipping arrangement. So the traditional 20-year LNG contracts that provide stable, predictable shipping demand, they are now becoming less common, and European buyers, mindful of their climate commitments, are increasingly favoring short-term deals. So on one hand, the regulatories are shifting. Other hand, we have seen the contracting structures are shifting. And then we are seeing Qatar is pushing for stricter destination clauses in its contract, that restrict the resale or redirection of cargoes. This shift towards shorter contracts and less flexible terms means more volatility in the shipping requirements. So rather than having a vessel dedicated to the specific trade route for 20 years, we may see more vessels operating in the spot market on the short-term charters. So this increases the risk for ship owners and potentially leads to higher freight rates to compensate for this particular uncertainty. There is significant balance sheet implications for energy majors and as well as the trading houses involved in these particular trades. They have invested in both production and shipping assets. So let's say for companies like Shell, we have Total Energies, and then the Chinese national oil companies. They have made significant investment in the US LNG projects, and at the same time they also have invested in the chartering of LNG fleet. So vessel that is going to be delivered 3 to 4 years later, it's already committed to these particular companies. And these integrated strategies, they now face disruptions. Let me give you another example, Shruti. We have a Sinopec a Chinese company. It has both long-term and a short-term offtake agreement with the US suppliers. And at the same time, it has also investment in fleet of LNG carriers. Now, let's say the China-US trade is effectively suspended for last 70 days. But if they remain suspended for the longer term, they must now find an alternative deployment for these assets. And if they were not able to find out, we may see potential write down their value. For the next generation of LNG projects seeking financing, this is instability and a very serious challenge. So bank and institutional investors, they will demand more conservative projections and higher risk premiums, and potentially making some projects economically unviable at all. So this directly impacts shipping demand forecast and vessel ordering decisions specifically for the ship owners. So finally, I have to say this. There is emergence of new trading patterns and actors. We are seeing some portfolio players like Shell and Total Energies. Now they are taking a larger role in optimizing global LNG flows as kind of a direct bilateral trade becomes more complex. So these companies, they kind of secure supply from multiple sources and deliver to the multiple markets, providing a buffer against geopolitical disruptions. Now from the shipping perspective, what does that mean? This means a more complex voyage instructions and the greater voyage optimization requirement. So rather than simple A to B journeys, vessels increasingly receive instructions for multi-leg voyages with potentially mid-journey redirection, and that is based on what? Based on market conditions. So that is the kind of a scenario for LNG market. But now the important role of transshipment hubs, it is also growing. So locations like Singapore, Malta, and then we have Spain's Algeciras, they are becoming increasingly important for cargo swaps and redirections. And this creates a new shipping patterns with the larger vessels delivering to these hubs, and then the smaller vessels, they kind of handling regional distribution. So in summary, long-term strategic implications of LNG divorce extend far beyond than the immediate market disruption. We are now witnessing a formation of new global energy architecture that has kind of a profound implication for shipping routes, and not just the shipping routes but also for vessel deployment in and ultimately the maritime infrastructure. So companies that can successfully navigate this shifting landscape will find opportunity, but those tied to the old paradigm may face significant challenges.
Well, thank you, Sandesh, for that detailed explanation of the entire situation. And this brings us to the end of the first part of this episode. And to all our listeners, please subscribe to our podcast. And until next time, navigate safely and stay tuned.